Hello and welcome to this week's market briefing. We've got a lot to talk about today. Bitcoin, one of them, US rate hikes and inflation and jobs releases, the Chinese economy, as well as much more. We'll be going over the charts and looking at what's to come ahead in the week, and also looking back and seeing what's happened and how that might affect the charts coming into this week. But let's get straight to it. We've got Bitcoin to begin with. Now, if you don't mind me just doing this. Now, as for Bitcoin, you may have seen last week, but Bitcoin's price slid back after the SEC pushed back ETF approvals. Now, this was when 7 asset managers applied basically for them to be able to establish a Bitcoin ETF fund to be able to sell on their own market exchange. But SEC basically said that they need more time to decide on the 7 ETF applications, and they weren't really interested in allowing a Bitcoin ETF from forming, mainly due to worries around market manipulation. Now, if an ETF was established, this would bring away a lot of the dangers around crypto to do with buying crypto through dangerous exchanges. And obviously we've had experience over that with last year, and the Sam Bankman-Fried saga, and a lot of the distaste that's brought to many people around crypto. And by bringing an ETF product to do with Bitcoin onto the marketplace, that's obviously going to bring crypto to the front stage. And so after the asset manager Grayscale won their court battle with the SEC around whether they could turn Grayscale Bitcoin Trust into an ETF, Bitcoin went up in price by 7% to $28,000 per Bitcoin. However, following the SEC's rejection of the ETF applications, we've actually seen a fall in the price back down. Now, the SEC have 45 days to decide on how to act with the court ruling to do with Grayscale's result, and whether they'll appeal the decision or try and reject it, or try and find some other justification for why they shouldn't allow ETF Bitcoin financial products. And next time it might be Coinbase's involvement as the basis for the next rejection, to do with why they might reject the ETF product. But moving on to the next article. Actually, before we do that, I'll bring up the chart of Bitcoin quickly so we can have a look and kind of see. This will come up, yeah. There we go. Sorry, it's taking a while. As you can see here, we've got Bitcoin, and as you can see, after the Grayscale court hearing, and Grayscale won the court decision to do with whether they were allowed to establish an ETF fund based on Bitcoin, we saw the price rise to 28,000. However, following the SEC's rejection of ETF funds from several other asset management firms and banks, we've seen the price of Bitcoin fall, and now it's trading around the 2,600 mark. So, well, not 26,000 mark, sorry. And so it'll be interesting to see how the price will trade around the next 45 days as we wait for the SEC's decision on whether they will allow ETFs to be established now that the court has ruled in Grayscale's favour, and how they might react to that Grayscale court decision. But apart from that, we can now move on to the next article, this time concerning the cooling US economy. Now, interesting data came out last week. Obviously, on Friday we had NFP, and we were able to see the rate of wage growth, as well as non-farm payroll figures and other employment figures. Now, jobs data shows that the US is cooling. We saw positive NFP, but then we also saw kind of worse levels of unemployment than expected. And so that's kind of showing that, we're not seeing too much growth in the jobs market, because we're still seeing decreased unemployment, but at the same time we're not seeing rate hikes hitting the US economy too hard, because we're still seeing jobs being added to the economy, and with that, the increased jobs being added to the economy is increasing the supply of labour, reducing the amount of vacancies, and therefore hinting to there being less inflation and thus less need for having rate hikes. However, it is presumed after now we've seen this data that rates will stay at restrictive levels where they're at, because as we saw, there were a healthy 187,000 jobs added, and so now the Fed feels like they can leave rates alone for the September meeting, and possibly wait even until November before they make a decision on whether to raise rates further. We spoke about this last week, but they kind of want to see how the economy is reacting to these raised rates, and now it's starting to feel as though the raised rates that were raised last year and this year are now truly being kind of felt by US consumers and US producers in the higher borrowing costs. And so it's important to see that for the Fed to be able to make the decision on what to do with high rates, because they obviously don't want to damage the economy, but at the same time they want to bring down inflation to that 2% mark, because it's still hovering around that 4% mark, core inflation. And yeah, monthly wage growth was below prediction of 0.2%, so that's positive for inflation. And we'll see how this has affected not only the US dollar but US indices after we get through all the articles, because it's interesting to see how this might end up being traded. And Joe Biden obviously responded to the data, claiming that that they were in the most positive and strongest job creation eras in history, with fewer Americans quitting their jobs, and inflation data on Thursday showing prices slowing despite inflation going up. It's not as high as it once was, in terms of how far it's increasing per month and per year. Or you can bring up the next article now, moving to China. Now, China, we obviously spoke about last week, concerning their slower growth, a lot of their drop in business and consumer confidence, the lack of confidence in their government, which kind of the economy is largely based on, as well as the fact that youth unemployment's quite high despite high education spending by parents, and obviously the failing property market, which most consumers and families did have their money in. And so it's seeing how this is affecting the wider economies around China, as a lot of the neighbouring countries obviously rely on China the most. And we've seen the greatest effect of this with countries like South Korea, which has extended to its longest slump in half a century. And obviously this is dangerous for the global economy, because they're seen as one of the leaders in terms of technological supply, especially within the region, but even internationally. Korea's exports fell in July at the steepest pace in 3 years. Not only that, but Japan also saw an activity drop for the 5th month in a row. Taiwan also noted contracting factory output, as well as weaker foreign demand. And all this concern has been led by China's fall and retreat into deflation, with soft consumption, a weakening currency, and poor levels of confidence. As I said, China's manufacturing sector has contracted for a fifth straight month in August. And as well as that, the most affected countries, or at least expected to be the most affected countries by this slump in China, is Hong Kong and Singapore, which geographically as well, especially for Hong Kong, would be most exposed to a weakening China. And given that Chinese demand accounts for 13 and 9% of their GDP, so any fall in their domestic demand and international demand is as a result going to affect Hong Kong and Singapore greatly, far more than countries like Japan. But even countries like Vietnam, Malaysia, and Thailand have also seen a deep drop in growth. And the Aussie dollar has fallen back to its lowest levels in 10 months following expectations of China's growth being scaled back. And this is after they've removed tariffs to do with their trade. So things are looking pretty bleak in the Asia market, but people are also expecting this to carry over to other markets as well, other regional markets. So it'd be interesting to see how this might play out in other areas in the next months. But obviously this will all play into the fact of how, the yen, the yuan, will play against the dollar, let's say, with their coming trade battles. And moving on, but staying on the China topic, Chinese lenders have extended billions of dollars to Russian banks after Western sanctions. Now, I'm sure many of you remember, following Russia's invasion into Ukraine, all the Western banks really pulled their support for Russian businesses and Russian oligarchs and anything Russian, basically. As a result of that, money needed, areas which money needed to fill needed to be filled, and so China stepped in. Chinese lenders funneled billions of dollars to Russian banks after the invasion of Ukraine, and this is a clear attempt by China to make the yuan rival the dollar. The lenders took the place of many Western banks, obviously, with banks like the Industrial and Commercial Bank of China, as well as the Bank of China, and China's Construction Bank and Agricultural Bank of China, all of which being involved. So all the key banks, even operating internationally, were heavily involved in this process of basically funding Russia whilst it engaged in its invasion in Ukraine, and still does. These moves of Chinese banks are essentially a part of a process of shifting Russia to adopt the yuan rather than the US dollar or the euro as a reserve currency. Now, this has been significant when you kind of look at the percentage change in how much of the yuan's been moving into Russia compared to the dollar and the euro, with the Russia and China trade level now being at $185 billion. Now, prior to the war, the yuan accounted for less than 1% of Russian payments or exports, and now the yuan accounts for 16%. So it's a dramatic increase in the percentage of payments that are coming from a different currency, and this is all part of kind of China's attempt to make the yuan a kind of rival currency to the dollar. But obviously, as we're seeing, and as I mentioned in the article before, China is not performing the best. So it's interesting to see how even a growing nation and a growing power such as China, whilst it's trying to make these attempts to grow itself and make it a world economic superpower, is still having great struggles in growing after COVID. But now, moving on from that, we're going to bring it to the charts. So I'm going to bring up the charts here. Now, the first one to be looking at is US indices. So we spoke about this last week, but this large area, pocket of resistance, really, US indices has now moved up into, and for good reason it's moved up into there, as we spoke about, with a more kind of positive information coming out of the US job releases as well as US inflation, where we kind of were able to see that the rate hikes weren't hurting the US economy, whilst also kind of preventing or at least whilst also not showing inflation to be growing at the same extent that it was before. And so this has had across the board a positive impact on US indices as they've ended with a positive week. I'll just show you here. So bullish week on the US 30, as well as on the Nasdaq, as well as on the S&P 500. So it's positive, it's a very positive week for US indices following all that data. Now coming to the dollar, we also saw a positive week with a breakout coming from this kind of channel that we spoke about last week as well, and almost a retest of that resistance, resistance and support that was highlighted before and last week. And now it will kind of be interesting to see whether the dollar will break above this prior high made last week and the week before. And if it does, I mean, it's pretty good news for the dollar to keep moving up. But it will all depend on inflation data. We can't just take 1 month's inflation data and jobs data and kind of, call it positive at that point, because this could all reverse just based on one economic data release, showing inflation still strong and still rising, and that in conjunction with strong wage growth and increasing employment, massive increases in employment. So keep an eye on the dollar, but it seems like it's going to be another positive week for the dollar, and that's represented on all the dollar pairs, obviously. And so it's just a point of looking out for areas to trade to the downside if it's pound dollar, let's say, or to the upside if it's USD JPY, as we can see here. The USD JPY is actually interesting because it's kind of sitting just below this area of resistance. So it'll be interesting to see whether it can break above and almost retest and move higher. And moving to pound yen, this is something I've been engaged in the last week. I kind of got in around the 78.6 Fibonacci level, catching it at the top of this fib channel, and it's kind of moved down into this pocket of support. And so I'm holding I'm holding bearish positions, but it'll be interesting to see whether it will break below this area of support. Now it's back under this kind of large trend line that was broken above, or it might bounce back up based on new data coming out this week to do with the yen. But that'll be something to keep an eye out. We've obviously already covered Bitcoin, and it will kind of interesting to see how Bitcoin will trade over the next 45 days as we'll wait for the decision from the SEC. And surprisingly, despite the dollar having a very strong week last week, so did gold. Gold pushed up from last week's positions of its lows last week of 1905, and it kind of rallied out of there, and it's now moving along this trend line to the upside. But following NFP, it kind of moved into this area of resistance at 1950. So it'll be interesting to see whether that will be used as liquidity to move to the downside again and continue this push to the downside. Because obviously it's reached its Fibonacci extension after gaining liquidity at the 50% mark. And so it's keep your eyes on gold and possibly bring in bearish positions following NFP and inflation data last week. And the last thing to bring up is US oil, which has seen a massive rally coming out of last week, and pushed up many points, making new highs not as we speak, but new highs which have only been touched last November. So it'd be interesting to see whether US oil will push back down to the 84 mark to maybe gain some liquidity again for a rush up, or it's just going to keep on pushing up, because as we can see here, super bullish movements. So keep your eye on US oil as well. But that's about it for the charts. The rest to cover is what's coming up this week. So let's bring up the economic calendar quickly and we can go over that. Sorry. So the first to note is the Aussie Bank interest rate decision. I know it's the RBA, sorry, interest rate decision. It'll be interesting to see how that'll play out on any AU pairs that you're holding. As well as that, we're seeing Aussie GDP growth rate being released next week, and this is in conjunction with the Euro quarterly rate that's being released, as well as the Japanese quarterly growth rate being released. And German inflation will also be released this week, alongside Canadian employment figures, and finally Chinese inflation rate figures, which will be very important considering how large China is in the news at the moment surrounding its economic troubles and its deflationary economy. So keep your eye on China, keep your eye on the dollar, and have a good trading week. But that's all from me. That's all from us at Wildwood Capital. And yeah, have a great week. See you later. Bye.